When most people think about biotech investing, they usually picture a specific narrative. It's almost like a lottery ticket, isn't it? You have these companies burning through cash at a terrifying rate, praying for a single FDA approval that either makes them billionaires or bankrupts them overnight. It's high drama.
Oh, absolutely. It's the classic binary event trap. You're basically betting on a coin flip with a PhD attached to it. But that's exactly why the company we're looking at today, BioMarin Pharmaceutical, or BMRN, is so fascinating. It completely defies that stereotype.
That's what caught my eye in the report. We aren't looking at a scrappy startup here. We're looking at what seems to be a machine that is suddenly printing money. I looked at the metrics, and one number just jumped off the page. Free cash flow growth.
Let me guess. The 600% number?
659%, to be exact. That is absurd. In a sector known for setting cash on fire, how does a company suddenly grow its free cash flow by nearly 700% in a year? Is that a glitch?
It's not a glitch, and honestly, that number is the heartbeat of this entire investment thesis. It signals a massive inflection point. See, BioMarin has spent years in that heavy lift phase, pouring nearly 30% of their revenue back into R&D. That's expensive. But what we're seeing now is the transition from promising science to operational maturity. They have a portfolio of rare disease drugs that are already commercialized, highly protected by patents, and are now generating pure cash.
So they've built the factory, so to speak. Now they're just cranking out the product?
Exactly. It's operational leverage. Every new dollar of revenue isn't being eaten up by building the infrastructure anymore. It's falling straight to the bottom line. When you see free cash flow explode like that, it tells you the business model works. And the market, which usually loves growth at any cost, is starting to wake up to the fact that cash is actually king again.
Right, especially in this economic climate. But let's play devil's advocate for a second. When I look at the valuation, it's a bit of a mixed bag. The report mentions a DCF, discounted cash flow, valuation of around $32, but the stock is trading over $60. That sounds like it's overpriced. Why should investors ignore that DCF warning?
That's a great question, and it's where a lot of purely algorithmic investors get tripped up. DCF models are notoriously bad at valuing biotech pipelines. They tend to be conservative and often fail to capture the exponential potential of future assets or the strategic value of a monopoly in a rare disease niche.
So the model is looking at the past, but the market is pricing in the future.
Precisely. And look at the other metric, price to free cash flow. It's sitting at roughly 14x. For a company growing revenue at 18% with gross margins over 80%, and let's pause on that, 80% gross margins, paying 14 times cash flow is actually incredibly cheap. It suggests the market hasn't fully priced in this new cash cow status yet.
80% margins, that's software territory. That's not normal manufacturing.
It is when you're the only game in town for a rare genetic disorder. That pricing power is their moat. It's a fortress.
Okay, so the fundamentals are screaming buy because the cash engine is roaring. But a stock doesn't move just because the accountant is happy. We need catalysts. The report highlights some major news, specifically an acquisition. They're buying AMA Therapeutics for nearly $5 billion. How do you view that? Is it a desperate grab for growth or a smart play?
It's definitely a smart play, and here's why. It diversifies their risk. Before this, BioMarin was heavily reliant on their existing blockbusters. By acquiring Amicus, they immediately add 2 growing rare disease drugs to the bag. It's like a landlord buying the building next door that's already fully rented. You get immediate cash flow accretion. Plus, it smooths out those scary patent cliffs that terrify biotech investors.
And the analysts seem to love it. I saw the consensus price target is over $82. That's, a 30% upside from here?
Roughly 34%, yes. And it's not just the acquisition. There's another catalyst that's flying under the radar, but is arguably just as important for the long term, the partnership with Viva Systems.
I saw that. Viva is a cloud computing company for life sciences. But why does a software partnership matter to a drug company's stock price?
Speed. In this industry, time literally equals money, millions of dollars a day. The partnership with Veeva is about streamlining the development and commercialization process. If BioMarin can shave 3 months off a drug launch or cut administrative costs by 10% using Veeva's data systems, that compounds that free cash flow growth we talked about earlier. It shows management isn't just focused on science, they're focused on efficiency.
So they're tightening the bolts on the machine to make it run faster. I like that. Let's pivot to the charts. I'm looking at the technical analysis section here, and it seems like the stock has finally woken up. It broke above $60. Is this a legitimate breakout?
It is a confirmed breakout, and this is a big but, timing is everything. The stock has surged recently, clearing both the 50-day and 200-day moving averages. That's the definition of a bullish trend reversal. The RSI, the momentum indicator, is around 65.
Which means it's strong, but getting a little hot?
Exactly. It's not quite overbought yet, but it's getting frothy. The report makes a very crucial distinction here between the investor and the trader. If you're a long-term investor looking at a 6 to 12-month horizon, the signal is a strong buy. You just get in, hold, and let that cash flow story play out.
But if I'm a swing trader, if I'm looking to make a move over the next 2 weeks,
then the signal is actually wait.
Wait, even though it just broke out?
Because you don't want to chase the bus after it's left the station. The stock is hitting some immediate resistance, around $61.40. The smart money, the sniper entry if you will, is to wait for a pullback. The stock needs to catch its breath. Ideally, you want to see it dip back down to test that $60 level it just broke. If it holds $60, that's your golden ticket. It confirms that old resistance has turned into new support.
That's a really helpful distinction. So, don't FOMO in at the top of the candle. Let it come to you.
Exactly. The risk to reward ratio is much better if you buy at $60, $75, or $60 with a stop loss just below $50. If you buy now at $61.30, you're exposing yourself to a natural pullback without a clear safety net.
Speaking of safety nets, let's talk about what could go wrong. We've painted a pretty rosy picture here. Cash flow exploding, great acquisition, technical breakout. But this is still biotech. What keeps you up at night regarding BioMarin?
Well, the biggest risk is actually the flip side of their success. That massive 659% growth in cash flow, it's spectacular, but it's also a hard act to follow. That number is going to normalize. Next year, they aren't going to grow cash flow by another 600%. If the market is expecting that exponential line to continue forever, there will be a disappointment.
Right, the growth trap. If they only grow by 20% next year, the market might throw a tantrum, even though 20% is great.
Precisely. There's also the integration risk with Amicus. Merging two multi-billion-dollar companies is never seamless. Cultures clash, systems don't talk to each other, key scientists might leave. If they botch the integration, that $4.8 billion price tag starts to look like a heavy anchor rather than a sail.
And I suppose there's always the regulatory boogeyman.
Always. Even with approved drugs, manufacturing issues can arise. Remember, these are complex biologic treatments, not simple aspirin pills. If a factory gets a warning letter from the FDA, the stock creates a gap down on the chart instantly.
It's high-stakes poker, no matter how good the balance sheet looks.
It is. But that's why the sentiment score in the report is so high, 90 out of 100. Despite the risks, Wall Street is overwhelmingly positive. You have 26 analysts saying buy, and almost no one betting against them with short positions. That creates a sort of herd protection. It takes a lot of bad news to turn a ship that has this much institutional support.
So, pulling it all together, we have a company that has successfully transitioned from a cash-burning R&D lab to a cash-generating business. We have a technical breakout that confirms the big money is flowing in. And we have a strategic roadmap with the Amicus deal.
That's the summary It's a classic growth at a reasonable price setup, which is rare in this sector.
If you had to summarize the action plan for our listeners in one sentence, what is it?
If you're an investor, buy it here and look at it in a year. If you're a trader, set an alert for $60 and strike when it bounces.
I like that. You know, it brings up a deeper question about the industry itself. We look at these numbers, 81% margins, billions in cash flow. And as investors, we cheer. But it reminds you that the price of health, especially for rare diseases, is incredibly high. These companies have to be profitable to survive, but there's always that tension between the profit motive and the patient need.
It's the ultimate philosophical dilemma of modern medicine. Without those 80% margins, the capital simply wouldn't exist to develop the cure in the first place. BioMarin is proving that you can build a sustainable, highly profitable business on the back of saving a very small number of lives. It's a fragile ecosystem, but right now, financially speaking, BioMarin is winning the game.
A profitable cure. It's a powerful narrative. We'll be watching to see if they can hold that $60 line, and if the Amicus integration goes as smoothly as they promise.
It's definitely one to keep on the radar. The next earnings call will be the real test of that cash flow durability.
We'll be listening. Thanks for breaking down the numbers with us today.
Anytime.
And for everyone listening, keep your eyes on the charts, but don't forget to look under the hood at the engine. Until next time.